Good morning everybody. Welcome to Basics of Stock Market. In this session, we are discussing what is stock market and how it is operates, etc. for the beginners. Those who do not have any idea regarding stock market or stock exchange or whatever the financial field, they will get a very good understanding and knowledge about the market operations after this session. A lot of people, those who do not have any idea regarding stock market, but they have a thinking that this area, that is stock market operations, is a highly risky affair. Some others think that this is a area of speculation or gambling. Some others thought that only high investment can only possible through or those people, that is HNIs, high net worth individuals, can only invest in stock market. Some others think that this is an area where high knowledge regarding finance is required. But these are myths. Any common man can become a very good investor, and he can make very good profit through investing and trading in stock market. So let us come to the area of stock exchange and let us go to the stock market. While thinking regarding stock market, I would like to give you go through an example so that you will get a better idea regarding the operations of stock market. Suppose a person, let us name it Mr. X, he wanted to start a business. Suppose he need a capital of 50 lakhs to start his business. He is having very good knowledge regarding that particular business, and he is having a very good experience in that field. So he wanted to start that business by his own. Suppose he is having 50 lakh money with him. He can start the business by himself. So he is investing the money from his own cash. So he is purchasing a land, building a building in the land, and erecting the machines. Everything he is doing by himself, and he could start the business by himself. Suppose Mr. X is having only 10 lakh with him, but his business, what he wanted to start, need a capital of 50 lakh. So what he is doing is, he discussed with some of his friends, and he find 4 like-minded friends from his friend circle, and the 4 persons accepted to join with him in the same business. So each person took 10 lakh each, and they created a capital of 50 lakhs. So 5 persons jointly started the business. Such a business is called partnership firm. Suppose the X is doing the business by himself, he could start the business as a proprietorship, and he could make everything by himself, whereas here he started his business because of the deficiency of money. He accommodated 4 other people also with him in the business, and he started the business as a partnership firm, and Mr. X became the managing partner of the company, and he is looking after everything. He started a business with his 4 friends, and the business is going very well, and after 2-3 years it's found that the demand for his product is so much compared with the supply. So they wanted an expansion. So for that expansion, they need another 150 lakhs for the further expansion. So the partners meet together and they discuss. So they can raise a capital of up to 50 lakh only with the 5 people. So they need another 100 lakh rupee. So what they do is, they discuss the business and everything with their friends, and they could find another 50 people who are ready to join with them with a investment of 2 lakh each. Thus, they made a capital raising of under 100 lakhs. And the business has gone very well. So, to accommodate those people, 50 people, Mr. X changed the partnership into a private limited company. And Mr. X became the managing director of that company, and the company gone very well. Under 2-3 years after, again the product is well accepted in the market, and the demand is so huge comparing with their capacity. So they wanted another expansion. This time they planned to make a private placement of shares. So they discussed within the directors of 5 people, the original partners, and again they discussed with the other shareholders, and they decided to go for a private placement. Whenever they discussed the same with new investors, the new investors asked 2 questions to Mr. X. The first question is, suppose I am investing in your company, how will be my annual return from your company? The second question is, suppose I want to sell these shares after 2 or 3 years, who will buy my shares and where could I sell my shares? So Mr. X answered to the both questions. He told that for the past few years, we are giving a dividend of 10 to 20% and an average of 15% per annum. So you will get a return of around 15% as dividend annually. So the investor is satisfied with that answer. For the second question, he answered that we are planning to list the company in the stock exchange after 2 years. So the second question is also answered by Mr. X, and the investor invested in the company. After 2 years, for the next level of expansion, the company that is, let us call that XYZ Limited, this XYZ Limited become a public limited company. So they changed the company from private limited to a public limited company, and they are decided to make an IPO, that is initial public offer. So through that IPO, they wanted to fix a price for the IPO. So they decided to put a premium of 90 rupees, that is for 100 rupee per share. Why this premium? Because while they took the valuation of the company, they found that the investment that made on land, etc., are 10 years before. So that the value of the land is multiplied several times, and the royalty of the business is high, and they took a valuation with a very good valuator. So they found that the value of the or net worth of the company per share comparing with the value of the share, it is more than 100 rupees, somewhere around 120 or 130 rupee per share. So they decided to issue the shares at a premium of 90 rupees. The issue is gone, and it is well accepted in the market, and they got 3 times applications. So proportionately they issue the allotment, and after allotment they listed the share in the stock exchange, the Bombay Stock Exchange and National Stock Exchange, both the premium stock exchange in India. So what happened? The share is listed, suppose we think the share listed at 120 rupee in the market on the first day of trading. So those people who applied shares and those people who got the shares at 100 rupees, they can sell the shares at 120 rupee and make a profit of 20 rupee per share. And those persons who do not get the share while applying, they can buy the share from the market if they thought that this share is a investable price for this particular share. So the price determination in a stock exchange will be through the buyers and sellers, or otherwise the supply demand on supply and demand. If the supply is high, that is sellers is high, the price of the share come down. If the demand is high, that is buyers is more than sellers, the price of the share will go up. So price determination is through the buyer and seller in the stock exchange. So the share price will be, every day there will be fluctuations, and the price determination is more or less accurate in a stock exchange. So through this example, you can understand how a business become big and big and big. So these ways how now lot of corporates that we can see as Reliance Group, Tata Group, Mahindra and Mahindra Group, lot of big business groups we can see in India. Those business groups become large and large through the public issue and raising capital through the public issue and listing in a stock exchange and trading in a stock exchange, so that both investors also making profit, the company can also make more profit, and the industrialization of our country is on a progress. In India, we have two stock exchanges, Bombay Stock Exchange and National Stock Exchange. Bombay Stock Exchange is the older stock exchange, whereas National Stock Exchange came in the 90s. The major question before us is why one should invest in a stock market. So stock market investment is one of the options of savings. Why savings? Savings is required because a person making money by way of business or a salary or a commission or whatever may be, he is having a lot of expenses also. So the difference between his income and expense will come as a savings. This savings is required because for his unforeseen crisis, financial crisis, or for his retirement life, or for the education of his children, etc., or a lot of things may happen in the future. So for that he need money as lump sum. So savings is needed for every person's life. So there is lot of options for savings. You can put your money in bank as fixed deposit, recurring deposit, or you can invest in real estate, you can invest in gold or other precious metals, and or likewise a lot of, or you can put your money in the fixed interest products like bond, debenture, etc. So there are a lot of investment opportunities. Investment in share market is also one of the savings opportunities. So why one go for a share market? In share market you will get better returns. Why better returns? Better returns you require because in bank you may be getting 5% or 6% interest, whereas the inflation now is 7%. So since the inflation is 7%, suppose we are getting a return from our money as 5%, the difference of 2%, that is the value of your money is decreasing. So anyway, from wherever you invest, you should get a higher return comparing with the inflation. Then only your money is actually increasing. So you need a higher return from your investment. So the question is, can I put all the money in stock market? No. You should have a balanced investment plan. So you can put some money in bank, some in gold, some real estate investment is good. Likewise, you should have to invest in share market also for a better earnings. So on an average, one can make a very good return from his total AUM. So that's how a person maybe plan to invest. So the next question before us is how one could start investing in stock market. One need a trading cum Demat account, where he should start a trading cum Demat account with a stockbroker. Stockbroker is a company where that company is having a membership in stock exchange as Bombay Stock Exchange and National Stock Exchange. So Bombay Stock Exchange and National Stock Exchange members will be called stockbrokers. So he can start a trading account with a stockbroker, as well as he should start a Demat account also. What is a Demat account? Demat account is a account similar to a bank account. We are starting a bank account to keep our money or our cash or Indian rupees. Likewise, to keep our shares, we have to start a Demat account. Suppose we take a statement from the bank, we can find in the last the net balance in the bank. Suppose 50,000 is the net balance, 50,000 credit will be shown in the statement finally. Likewise, if you take a statement of your Demat account, suppose you are having 4 shares, say first share is Reliance, you are having 50 numbers of Reliance, and the market price of Reliance is, suppose you assume 2,000 rupees. So the company name will be there, Reliance, then number of shares will be there, then the current market price. So number of shares into current market price, the total amount will be in the last column. So while we go through the statement, you can understand how many shares, how many companies you are having holding, and what is the net asset of each company and the total investment in shares. How this trade circle will happen, let us see. So I told you, suppose we are buying some shares from National Stock Exchange, the trade cycle will be like this. We are putting the order through a stockbroker. How can we put the orders? There is 3 ways to give an order, either of buying or selling shares. One is you can go to the nearest branch of your stockbroker and give the order physically, or you can telephone the stockbroker and give the order. And nowadays the broker is having online trading terminals. So if you install the software of the stockbroking company in your laptop or desktop, you can buy and sell from your home or office, wherever you stay. And another third option is the broking company nowadays having mobile app also. So suppose you install the mobile app in your mobile, you can see the holding of your shares, and the daytime you can see the trading of each and every share and prices, everything, as well as you can buy and sell shares also through the mobile app. So either of these ways you can do business in shares. Let us look how this trade cycle will happen. Suppose a client wanted to buy 100 shares of Tata Steel, and the price of the Tata Steel, suppose we can assume that 1,000 rupees per share. So the price for 100 shares will be 1 lakh rupees. So he can put the order through either of the above ways. Suppose he got the share at the market rate of 1,000 rupees, and this client purchased through his broker from National Stock Exchange. So the trade cycle will be T plus 2, that is trading day plus 2. So suppose the client purchased this share on Monday, he have to the third day, that is on Wednesday, the trading circle will end. So suppose the person purchases on Monday, the trading account will be connected with his bank account and his Demat account. Suppose he purchases 100 shares on Monday of Tata Steel for a price of 1,000 per share. The money, that is 1 lakh rupee, will go from his bank account to the stockbroker. Then stockbroker will pay the money to the stock exchange. Likewise, the person who sold the shares from another stockbroker, from that client, the shares, that is 100 Tata Steel, will debit from his Demat account, and the shares go to his stockbroker, and from the stockbroker the shares goes to the National Stock Exchange, and the shares go to the purchased broker through the client, and the money that on the other hand will go to the sold stockbroker through the client. and on Wednesday seller of the share will get the money and the buyer of the share will get the shares in his Demat account. So this is a 3-day cycle of trading, that is T+2. So on whatever he done on Monday, the settlement is finalized on Wednesday. So the stock exchange will function 5 days in a week, that is Monday to Friday, and Saturday and Sunday are holidays. So trade cycle will be happen likewise after Friday, next Monday, likewise 5 days in a week. The trading time of a stock exchange will start from 9 a.m. to 3:30 p.m. Out of 9 to 3:30, 9 a.m. to 9:15 a.m. will be the pre-opening session. In the pre-opening session, from 9 to 9:07 you can put orders, but the trade will happen from 9:15 a.m. So the actual trading time will be 9:15 a.m. to 3:30 a.m. So during this time, a client can put orders. The orders will executed on the spot, and he will get confirmation also, and likewise he can do business through any of the stockbroker, as I told you. Now let us study what is Nifty and what is Sensex. Nifty is the index of National Stock Exchange. Nifty comprises of 50 shares. 50 shares means these 50 shares are from all the industry, and each industry the best company will be selected for the Nifty. Suppose we are taking IT industry. The best industries, the companies from IT industries will be Infosys, Wipro, TCS, etc. So suppose we are going for steel industry, Tata Steel, Jindal Steel, etc. will be the best companies. Suppose we are going to the cement industry, ACC, Ultratech, etc. will be the best companies. Likewise, the best companies will be included in the Nifty 50. So what is the importance of Nifty? Suppose how can we understand in a particular day whether the market gone up or market gone down? Suppose there are thousands of shares that is trading in a stock exchange. Some shares gone up, some shares go down. So while we go through all the shares, we cannot find out how the market performed in a particular day. In such case, we can just go to the index and we can understand the overall market was up or overall market was down by just checking the index of the stock exchange. Likewise, Sensex is the index of Bombay Stock Exchange, which comprises of 30 shares. So that is also selected from the different industry and the best companies from each industry. So Nifty and Sensex are the two main indexes in Indian stock exchanges. Here we are going to discuss the different segments of trading. So the first segment that we are going to discuss is cash market. In cash market, the settlement is on a daily basis. That means from morning 9 a.m. to 3:30 p.m. is the daily trading time. So the settlement starts from 9 a.m. and closes by 3:30 p.m. So the shares that are purchased in the morning or during the day should be sold out within the day if he wants to close the positions. Otherwise, whatever may be the net position, he should have take delivery. That means, suppose one purchased 1000 shares of Tata Steel, but he sold only 900 shares, then the net quantity, that is 100 shares of Tata Steel, suppose the price is 1000 rupee. So the 1000 into 100, that is 1 lakh rupee, will be his paying due for the 100 shares delivery. But there is also one more factor. Suppose he purchased 900 shares and sold 900 shares, so there will be a debit or credit from that trading. So suppose he has some credit, he should have paid the balance amount only. Whatever it may be, the cash market is for investors mainly. Suppose you want to take some delivery or you want to invest in some shares. So you can, that is the area where investors are doing business is cash market. So in cash market you can buy any shares, and the third day you will get delivery in your Demat account. From there onwards, all the benefits that a shareholder is getting from the company you also will get. That means once you bought a share and the shares transferred to your Demat account, you become a shareholder of that company. That means you are one of the owners of the company. So suppose any corporate action is taking place after that, that is bonus, stock split, or rights issue, or dividend, whatever it may be, the shareholder will get all the benefits that the company may announce time to time. So there will be, suppose there are a lot of investors who invest for long term. Suppose they invest today, they will keep the shares for years, so that they maybe get lot of benefits from the company, especially good companies or frontline companies, or those companies which are growing fast. Such companies, suppose you are investing, your money or the investment will be multiplied several times during the period of or during the years. So there are so many investors, those who are invest for long term, and there are investors who are investing for medium term, that is for 6 months or 1 year. Within that period they may be making 20% profit or 30% profit or 50% profit, then they sell it off and book the profit. There are investors for a short period. Suppose they are investing today, and suppose the share hike by 5 to 10% within a period of 1 week or 2 weeks or whatever period, immediately they sell off the shares and book profit, and they buy another company, another share, and they going on doing like that. And there are traders also in cash market. That means the intraday buy and sell. During the day they purchase and sell the shares. At the end of the day the position will be nil. Such cases they have to keep margin money only. Suppose the margin percentage for a particular share is 20%. For example, Tata Steel, let us take Tata Steel, the margin money that exchange will be periodically change the margin money for each share. So suppose the margin for Tata Steel is 20%, he have to keep 20% as cash or a margin pledge, so that he can buy shares with a margin. So that he can, suppose 20% is the margin money, he can put 1 lakh rupee and he can purchase up to 5 lakhs intraday. So that is the intraday operators or intraday traders will operate in cash market. Next segment is F&O, that is futures and options. In F&O there is two products, one is futures and other is options. First let us think of futures. In the futures market, the settlement is only on a monthly basis. That means last Thursday of the month will be the settlement of futures. Suppose a person buys shares in beginning of the month or 1st or 5th or month or whatever it may be, he can keep the shares till the last Thursday of the month, that is the settlement date, till the settlement day of the month. So that what happened, he also have to put a margin and he could keep the shares, and he can, whenever the price is hiking, he can sell. Likewise, he can also sell first. Suppose he thinking that the price of Tata Steel will go down in the coming days, first he can sell. Suppose he is selling the shares for 1000 rupees and the shares is coming down and it come down to 990 rupees, he can cover the shares at 990 rupees, the profit will be 10 rupees per share. So purchasing at 990 and selling at 1000 is equivalent to selling first at 1000 and buying at 990 after some days. So both ways he can make profit in futures. And what is the importance of futures? Suppose in the example of Tata Steel, one is putting a margin money of 1 lakh and he is purchasing 5 lakh rupee Tata Steel. What happened? Suppose the Tata Steel is the price of the Tata Steel is going up by 2%. That is, suppose he is purchasing at the 1000 rupees and the share price is gone to 1020. That means the price of the share increases by 2%. So what is his profit? 20 rupee per share. What is his quantity? 1000 rupee shares into 500 shares. So he purchased 500 shares and he is making a profit of 20 rupee per share. So 20 rupee per share means 20 into 500. That means he is making a profit of 10,000 rupees. So while we compare with the basic investment of 1 lakh, his profit, even though he made the share is increased only by 2%, his profit will be 10% because he invested only 1 lakh rupee. So 10,000 out of 1 lakh investment comes to the 10%. So 10% profit he made on the 2% increase of the share price. The similar thing when it happens, suppose the share price goes down and he sold the share making a loss of 2%, his total loss will be 10% of his investment. So there is two sides for futures. Chance of making profit is also high, making loss is also high. So this is a area where futures are doing. But the major difference is in futures you cannot buy or sell small quantities. For every futures there will be a lot size and you can purchase or sell in the multiples of lot size. For example, for Reliance Industries, the lot size is 250 shares. So you can buy and sell in multiples of 250 shares only in the case of Reliance. In the case of Tata Steel, 425 is the lot size. So you can buy or sell in multiples of 425 shares. So that is the difference between cash market and futures market. So futures market lot size is fixed by the exchange or national stock exchange so as to the value of the lot will be in between 5 lakh and 10 lakh. So over the period of time, you know, there will be changes in the prices. Suppose the price of the share is increasing and the lot size amount may be above 10 lakh. Every 6 months the periodical review will be there by the National Stock Exchange, and they change the quantity of the lot size. Suppose the value of the shares increased and the total value of lot size is above 10 lakh, they will decrease the lot size. Likewise, if the share price go down and the value of the lot go below 5 lakh rupee, then they will increase the lot size. So both sides they will make reviews every 6 months and change the quantity or lot size. In futures, there is stock futures as I told you, but there is index futures also. That means Nifty can also be traded in futures. What is the importance of Nifty trading? Suppose you purchase a Nifty, it is equivalent to purchasing 50 best shares. Okay, so purchasing a Nifty is equivalent to purchasing 50 shares. So the volatility in Nifty is comparatively lower than the individual share. So and another thing is Nifty movement is also an indicator of the market movement. So every individual who is looking on the stock market, and stock market is the variation will be the index is an indicator of the variation of the stock market. So everybody is so keen on the indexes. So suppose Nifty is increasing, you can make profit. Suppose Nifty is coming down, you can you may be suppose you are buying Nifty, you may be come to an end. But at the same time, the difference is you can sell Nifty first. suppose you think that the market is going down, you can sell Nifty first and buy afterwards. Suppose Nifty, current Nifty is 17,000. Suppose you have an assumption that the market will go down in the coming days. So first you can sell the Nifty at 17,000 and you can purchase the Nifty after 2 days or 5 days or 1 week when the Nifty comes down by 500 points or 300 points or 1000 points, wherever you think the Nifty will be getting a support, you can then purchase the Nifty, and in that case also you are making profit, because first you sold at a higher price and you are covering at a lower price. So the difference between the purchase price and selling price will be your profit. In Nifty also there is a lot size, 50 numbers is the lot size of Nifty. So in the case of Nifty, the margin is comparatively lower. In scripts, the margin will be 20%, 30%, 40%, etc. depends on the volatility of the script. Whereas in the case of Nifty, I told you the volatility is comparatively lower in the Nifty, because the Nifty is comprises of 50 different companies, 50 different shares. So suppose one share is going up and another company share is coming down, the net effect will be nil. So suppose out of 50 shares, 40 shares going up and 10 shares coming down, the net result will be up. So likewise, always you don't think that all the 50 company will go up and all the 50 company will come down. Never, it will not happen usually. So some companies will go up and some companies will come down, and majority of the shares are going up, and the quantum of the hike is higher, then the Nifty is also moving upward. So in such cases, we say that market is going up. So Nifty is a very good indicator of the market. So Nifty can also be buy and sell in the futures, and there also you are getting 1 month time. That means the last Thursday of the month is the expiry. So you can keep the shares till that day. So suppose you purchased the Nifty for 17,000 and Nifty is not going up, and you will not get an opportunity to sell at a very good profit as you thought. But at the end of the expiry, suppose the Nifty is down by 100 points or 500 points or whatever it may be, there is no need of closing down your position. You can roll over your position. That means suppose you bought on July series and you are keeping the July series till the end of the expiry, and then you can roll over to the August series by selling the position on July series and purchasing the fresh position in August series. So there is an opportunity to roll over in the futures also. So suppose you are purchasing Nifty and you are not getting an opportunity to sold at a profit, you can hold the position to the next expiry, and suppose in August there will be a hike in good market comes and good rally you got, and suppose you can the market go up by 200 points, 500 points or 1000 points, whatever may be the market level, you can sell the Nifty and make a very good profit. So there is a lot of opportunities in futures market. So this is the opportunities that we find in the future market. So then next segment is option market. More opportunities are there in the option market. The option market, there is two size of options. One is call option and the another is put options. And while studying the full level of option, it will take another half an hour to 1 hour to explain everything regarding the options. So in this session for the beginners, I am only touching how the option works and how are the opportunities in option and what is an option. So that things only I am discussing in this session. In options, there is a strike price that is fixed by the exchange. So for example, in the case of Nifty, 16,000 is a strike price, then 16,050 will be another strike price, 16,100 is a strike price, 16,150 will be a strike price. So every 50 points there will be strike prices. So there is both, as I told you, put options and call options will be there in each strike price. For every strike price there will be a premium. Then the premium means that is the intrinsic value plus time value is called the premium. That means suppose current market rate is 16,000 for Nifty, and suppose I want to buy the 16,000 call or 16,000 put. I will not get at a zero price. Suppose the option is closing time is 4 days from now, there will be a premium. So why premium? Premium is because of the time value of 4 days. So always, suppose I am current market rate 16,000 and I want to take a call option of 16,100 till there will be a premium. So wherever I go and purchase a call option or put option, there will be a premium. That premium means that is we are giving a value, time value money. So that is called the premium. So there will be a strike price and there will be a premium for in the case of options. Then as I told you, there is two type of options. One is call option and another is put option. And suppose let us take a call option. Call option buyer you can consider as a person who is taking a long position or a buyer of that stock or index, whatever underlying asset. Likewise, in the case of put option, you can compare it as a seller of a underlying asset. That is the stock or index, whatever may be the underlying asset. Suppose one is buying a put option, he is taking a short position in the underlying asset. Selling of call option is just like a short selling. Likewise, buying a put option is like a short position, selling a put option is like taking a long position. So that is how the trading pattern will be going on. This is I am telling you for the common man view. That's what I am telling like this. So you can understand what is call option, what is put option. So buying a call option means you are making a contract between the seller to buy the underlying asset at a specific price within a specified time. Buying a put option means you are making a contract with the seller of the put option to sell the underlying asset with a specified price within a specified time. So call option and put option are two different options, whereas you can make the position of the underlying asset. So the buying of a call option or put option is also called the holder of the position, whereas selling of put option or selling of call option is also called the writer of the option. However, you understand one thing, that in between we compare between the different segments of the trading, that is cash market, futures, options, etc. The highest risk segment is the option segment, and after that you can the risk is in the futures segment, and the lowest risk segment is the cash market segment. So you can consider option as the highest risk segment. At the same time, whenever you take more risk, the profitability is also higher. So in option segment, there is huge possibilities for making huge money, so that there is also higher risk involved in the option segment. Futures and options are also used for hedging your positions. Suppose you are having 500 shares of Reliance in your Demat account, and suppose the market is going down and you know that the market is going down for another 1 month or 2 months, or the trend of the market is negative. So what you can do is you can hedge, you can sell your Reliance and buy after 1 month or 2 months You can do that in the cash market, or otherwise you can keep the shares in your Demat. At the same time you can sell in futures. Suppose you are selling 2 lots of Reliance in futures. So you are having a position in your Demat account, and suppose the market, as you thought, gone down by say 50 rupees or 100 rupees, whatever it may be, you can cover the position after a couple of weeks or within a month or after 2 months. So that what happened, you are hedged the position, and the loss that may happen in your cash market position or Demat position, you will be hedged in the futures market, so that the total loss you can diminish, whereas you got a profit in the futures market. The same thing can be also happen by taking put options. And another thing is, suppose a person bought Reliance Industries for 2000 rupees and the market gone to 2500 rupees. So he made a profit of 500 rupees per share. So he can sell the shares in the cash market. But he don't know whether the market go up again or what may happen. But he made a very good profit. So what he is doing is, he sell the same position as he is having in the Demat account in the futures market. Suppose that means he is already booked the profit. Suppose 2500 the market goes to above, he already made a profit of 500 rupees. Whatever loss he is made in the future will be a profit in the cash market. Suppose the Reliance share price come down by 100 rupees or 200 rupees, and he could cover the position in the futures market, and his Demat position will be there, and with the position of 500 shares in his Demat account, he is making another profit in the futures market without much risk. So such trading can also will happen in the futures market for the investors also. So a lot of opportunities are there in the futures and option market. They can trade, they can positional trade they can use, they can hedge for their position in the cash market. Lot of things they can do in the futures and option markets. Then let us come to the last part of this session, that is the tax implication of the stock market operations. So suppose you are doing trading in cash market, there is 2 types of investors you can see, that is long term investors and short term investors. Long term investors means those people who are sell shares after 1 year. So suppose you are selling shares after 1 year, there is only a long term capital gain, that is only 10%. Whereas if you buy and sell within a year, so your tax implication is 15%, that is short term capital gain. So whatever you are doing in share market, your tax implication on income tax is only maximum 15%, whereas suppose in the other normal business income you have to pay up to 30%, whereas here it is limited to 10 to 15%. Long term capital gain is 10%, whereas short term capital gain is only 15%. And if you are doing in futures and option market and you are making a very good profit, it is considered as business income and it is included in your normal business income, and you are taxable as applicable in the income tax slab. So that is the tax implication of the profit from stock market. There are sector-wise indices also in National Stock Exchange, that is Bank Nifty, Pharma Nifty, Nifty IT, etc. So one can trade in the Bank Nifty also. Bank Nifty is also having a very good volume. Nifty is also having a very good volume in National Stock Exchange. So there is a very good opportunities in trading in indexes also. So that's all for the segments wise details of the stock market. And there are lot of opportunities that you understand from this session. That is, there is opportunities in the cash market for investors. There are two types of investors, short-term investors and long-term investors, and tax liability is also different for different types of investors. And there is a lot of opportunities for the traders in the futures market and option market. These are all for the stock market operations, and we conclude by this time, but we are coming out with another session by options trading, and that is a very beautiful and very informative session. So you go through the next video, that is option trading video, so that will be more informative regarding the option trading. So that's all for today. Wish you all the best. Thank you.